Assalamualaikum and hello everyone, welcome back. Today we're going to discuss another past exam question. This is a past exam question that has been edited for the preparation of consolidated statement of financial position involving a parent and a subsidiary, a simple group structure. And this is March 2013, where I've edited few information to suit the current accounting requirement. Here you have your two companies, Intan Berhad, which acquired the shares and debentures in Payung on 1st of November 2000X1, when Payung's Berhad's retained profit and general reserve were 100,000. So these are the information relating to pre-acquisition reserve. And the 1st of November 2000X1 is the date of acquisition. It is the same for both ordinary and preference shares, and the retained profit has credit balances as well as the general reserve. So make sure this one should be included in the fair value of net asset. This should also be included in the fair value of net asset as you try to calculate any goodwill or bargain purchase. Okay. Then you have the summarized statement of financial position of Intan and Payung, which is as at the 1st of December 2000X2, and by now you know who is the parent and who is the subsidiary, because Intan is the one that acquired the shares. So this is the parent company and this is the subsidiary. You have the non-current asset. Remember this figures that you have here, the thing that you have is very important because you are going to later prepare the consolidated statement of financial position. So you have the information on the acquisition of ordinary, preference shares, and also 10% debentures. Remember to calculate the goodwill for each of the acquisition separately, or if there is any bargain purchase. You have the current asset and all the details here. Let's look at the requirement before we go further. You have to prepare the consolidated statement of financial position of Intan Berhad and its subsidiary as at 31st of December 20X2. So if you recall, the date of acquisition is this, and you are asked to prepare after a year, 31st of October X2. So this is the date of acquisition and this is the current financial year end. So this is where you have all your pre-acquisition reserve, right? Okay, and if you see the details here, when you are asked to prepare the consolidated statement of financial position, of course, this will be your target or your primary objective to prepare the consolidated statement of financial position for the group and its subsidiary. However, since you are asked to show all workings, and this is for the purpose of exam, so you're going to prepare not only this consolidated statement of financial position, you're also going to prepare the schedule. That schedule will show you, or will have to show, the calculation for goodwill or bargain purchase. That schedule should also be able to show the composition of the group reserve, right? Group reserve, and it should have the detail of retained profit or the general reserve. Yeah, which one belongs to the parent, which one belongs to the subsidiary, which one belongs to the parent and to the subsidiary. Then if you have the non-controlling interest, so this must be shown as your workings, and that is also advisable if you can do that together with some simple consolidation journal, CJE, for all the intercompany transaction or any elimination. That is the thing that you need to do. Then only you will prepare your consolidated statement of financial position, right? That is what you need to do. Okay, so basically, when you prepare your consolidated statement of financial position, you are going to combine the result of the parent and the subsidiary. This is the parent, this is the subsidiary. But you will have to eliminate the intercompany transaction. But the first step is to combine. So you are going to combine this asset, but you are not going to include this because this investment, this will not be included because this will be eliminated. These are going to be combined first, then you will do the elimination, this one as well. Current account will not be included, it will be eliminated. Ordinary dividend receivable, we will also need to check if that need any elimination. So this one you need to KIV, right? You may have to see whether that is being recorded by the parent solely from the subsidiary, or is it as a result of also receivable from other sources or outsiders. Okay, ordinary share capital. When it comes to ordinary share capital, you are just going to include just the one of parent, but you're not going to include the result of the subsidiary because subsidiary share capital will be eliminated. So retained profit, this one will be included, but this will have to be worked out from the workings, and you need to work out that from the schedule. So you're going to do that. Debentures, you're going to add the one of the parent and the one of the subsidiary, but you need to go and reduce with the amount acquired. Accounts payable will be included, bills payable will be included, you will have to add. Only dividend payable, you are going to include, but you are going to eliminate if there is any intercompany transaction, either intercompany group dividends or intercompany group debenture interest. Okay, so this will have to be checked. So you need to go and add, but at the same time you need to go and eliminate. Current account will not be reported because this will be eliminated. You need to go and find out the differences in the current account. What caused the differences? Is it due to the goods in transit, or is it due to cash in transit? So that's the first few things. The one that I put across is something that you shouldn't include in the consolidated statement of financial position. Remember, the share capital, and here we are talking about ordinary and preference share capital, this will just be the one of the parent only to be included. So in a simple way is that you're going to prepare something like this here, consolidated statement of financial position. That will be what you will prepare later. You're going to have the one of the parent, the one of the subsidiary to be combined, and you're going to include those items that I have mentioned here, and you're going to take the figures and include that figures in the consolidated statement of financial position. And then only you can start thinking of doing all the consolidation adjustment. In exam, this will take a faster time to do if you have done the combination first. So let's do that first before we go on doing the elimination. So the one of the parent and the one of the subsidiary is the one that you need to go and include it, right? Okay, so this will be included here, and I have already done that. So you have to just copy this. All right, put it here. Okay, then what will be done later is for the inventories part, do not include the investment. In case you have a goodwill, we can insert the goodwill here. We will have to calculate that later. For the inventories, just go combine first. Remember, up till the cash at bank, do not include the current account, right? Because current account, you will have to eliminate. So let's look at what caused the different in current account later. But in this question, actually the different in current account is due to cash in transit. If you read the information given in number 6. So number 6 is what it explained regarding the differences in the current account, which is due to cash in transit, right? So that one will be included later. Okay, then you can leave the ordinary dividend receivable will not be included, because if you check, you would notice that this is due to the share of the parent in the subsidiary that has been recorded. So for a group statement of financial position, you won't report intra-group dividends, since dividend here is a dividend that you will later discover that was received from the subsidiary. This will not be reported, and simply conclude here is that there are no ordinary dividend receivable to be shown here, right? And then ordinary shares, as I mentioned, do not include the one of the subsidiary, so just include the one of the parent. Group retained profit will be doing last. These three items here: group retained profit, group general reserve, and non-controlling interest, that has to be worked out through the schedule. For the debenture, at the moment, you can just add the two figures here without doing any elimination for the amount that has been acquired. No cancellation yet. Same goes for the rest of the item in the current liabilities. You just add them so that you can get free marks here, right? Free marks, meaning that it's easy for you to get at least marks for the amount that you have combined. Do not include current account, because we have to eliminate the current account. Remember, the purpose of current account is normally to record all the intercompany transaction and to make it simple when the company have numerous intercompany transactions. So current account is being maintained. However, when you do your consolidation, the difference in the current account must be actually being eliminated and being cancelled off, and that is normally due to two reasons: goods in transit and cash in transit. So after you have done that, now you can do the combination. Yes, you have done. We can now do the information as per the additional information. So earlier you have already been informed that you have acquired the ordinary and debentures, and here is your consideration transferred. This figure here, this is the consideration transferred. I'm going to write here consideration transferred for the ordinary shares. Yeah, this one. This is the consideration transferred for the preference shares, and this is the consideration transferred for the debentures. So you can make use of that consideration transferred to calculate your goodwill. And here you have the information regarding how much is being acquired. So I've already calculated for you the percentage of amount that has been acquired. So if you look here, the ordinary shares that were being acquired is actually 800,000 out of the information given there, 1 million. Okay, out of the 1 million. So 800 out of 1 million, you get 80%, and NCI is 20%. For the preference shares, what you would see is that you acquire 30,000 units of shares out of the 100,000 6% ordinary, preference shares, and that will give you 30%. So the NCI 70%, debenture, we are talking about 10% debenture. Yeah, 10% debenture. Sometimes you may have 2 or 3 types of debenture. Make sure you take the correct one. So it's better to label them correctly as well. So this is 6% preference shares. So the debenture that has been acquired is RM 40,000, and that is, if you want to know from how much, you should go a little bit at the bottom there. This is the amount of debentures that are available in the carrying amount of the subsidiary company. So from the 80,000. Okay, so you will have 50%, and that will remain. The difference will go to the other debenture holder. Okay, you are done with that. Now what we can do is we can look at the additional information and start working that to get the figure that you can later use to do your consolidation adjustment. So let's do it here side by side. Information number 1, on the date of acquisition. Remember, the date of acquisition is on 1st of November 2000 X1. The property, plant and machinery. So let's just stick them some highlighter so that we can highlight important information here. Okay, you have the PPE, the PPE. Oh, I don't know what happened to this highlighter, never mind. Okay, perhaps this will work. Still not working. Oh, okay, just use the pen then. Take a different color. Okay. So you have the property, plant and equipment that were revalued at 290,000. So this is the value or the fair value on 1st of November. For the property, 290,000, and the plant and machinery were revalued at 315. So property is a non-depreciable asset, and plant and machinery is a depreciable asset, depreciable PPE. Payung has not recorded the revaluation, so this is the unrecorded revaluation, and the group policy is to provide depreciation on its non-current asset at 20% reducing balance method. So the date of acquisition versus the current financial year end, which is 20x2. So that is exactly after a year that the revaluation took place. So you need to go and find out that what is the surplus or deficit, and again what is any, if any, depreciation adjustment. So I've already done it here. You can check the workings here. For the property, you need to compare the fair value. The fair value is 290 given here. Okay, and that would be compared with the carrying value. Carrying value 270. Here, to find the carrying value is quite easy because property is not depreciated. So if you can go to the property, you would notice that this is the carrying value on 31st of October 20x2. The carrying value is 270. And again here also it is 270. It is the same. Why it is the same? Because it is a non-depreciable asset. So you would compare the fair value with the carrying value. When you compare, this will give you a surplus. And that surplus is surplus which is revaluation surplus that has not been recorded. So now it has to be recorded. We record debit property, credit ARR, Payung, the subsidiary, and we will adjust the pre-acquisition profit. And when you do that, you also need to go and adjust in your non-current asset later when you prepare your Sofp. Go and add to the property. We'll be doing that later. At the same time, you also need to adjust your fair value of net asset figure. What I mean by that is that when you calculate your goodwill, make sure you take into consideration the asset revaluation reserve on the date of acquisition to be part of the fair value of net asset. Okay, done. Next one is for the plant and equipment. You would have to find out what is the carrying value on 1st of November 2000 X1. You need to find out that is on the date of acquisition. To do that, you can use the same technique, which is to gross up 260,000. Where do I get 260,000? 260,000 is here from the plant and equipment of Payung. That was not on 31st of November 2000x2, that was on 31st of October. So you need to gross up. You gross up by just 1 year. That's why you multiply by 100 over 80. Where do you get 100 over 80? It is because the depreciation here is 20%. So when it is 20%, you gross up, you will take 100 over 80. And you just grossing up for 1 year. So you straight away get the figure to be 325. If you gross up this, you get 325. You will compare with the fair value on the date of acquisition. That was 315, and therefore it is greater by 10,000. And because this is a deficit, you will go and debit retained profit Payung. Yeah, this is the revaluation deficit that happened on its initial revaluation. You will debit to the retained profit, not debit to the ARR. You will be credited to the plant and equipment. So when you debit retained profit, it was on the date of acquisition, so you need to adjust pre-acquisition balance. And when you do that, you need to also adjust the retained profit workings, retained profit workings in your fair value of net asset. So here again, the fair value of net asset, right? Fair value of net asset, it has to be adjusted as well. Next, you also need to adjust the depreciation. Whenever you have a surplus, it will give rise to depreciation adjustment, which is an under provision. But here you have a deficit. So deficit will have to also be related to the depreciation, where it is going to be an over provision of depreciation from the date of acquisition, 1st of November 2000x1 until the current financial year end, 31st of October 2000x2. So we're going to adjust the depreciation. How? We take the deficit, we'll multiply by the 20% and times 1 year. So you get 2000. Depreciation over provided means you need to go and reduce to your retained profit. So when you reduce to your retained profit, that will have to be reduced in the schedule. So when you do in the schedule, basically that will need you to go and adjust in the schedule, similar to this as well. Which part? You are going to adjust in the retained profit of the subsidiary, because it's the subsidiaries retained subsidiaries asset that were being revalued. Okay. Next, it will also need to be adjusted in the Sofp. So the Sofp will need to be added with the over provision, since the asset is shown at its carrying value. So it has to be adjusted as well there. Next is the second part. Second part is the bills. For the bills, you need to find out how much is not yet discounted. So it's quite easy here. You are informed all the bills payable were in favor. Yeah, what is matter here is the amount being undiscounted. So has not been discounted. So that is the entries that you need to do in terms of consolidation journal. Debit bills payable 20,000, credit bills receivable 20,000. So when you debit bills payable, it's a liability. Go and adjust in the current liabilities later in the Sofp. Okay, and you also need to adjust in the Sofp for the current asset. So all these are in the Sofp, the one with the green color there. The next one is the intercompany sale of motor vehicle. Go and identify who is the seller. Payung is the subsidiary, so subsidiary is the seller. It's sold off to Intan. Intan is the parent, and parent is the buyer. So the motor vehicle has a carrying value of 80,000. So this is the sale proceed, and you are informed the carrying value on the date of disposal was 80,000. So this is easy. You just take the selling price, 90,000, carrying value. This is to the point of view of the subsidiary as the seller, because Payung is the seller, right? And the difference between carrying value on the date of acquisition and selling price on the date of acquisition, you need to go and adjust the unrealized profit. You need to adjust in the subsidiary because subsidiary is the seller. So you will adjust in the subsidiary retained profit later in the schedule. How? Debit retained profit of Payung. So when you debit retained profit of Payung, you need to go and adjust in your schedule. And when you credit motor vehicle, you need to go and adjust in your statement of financial position. Whenever there is a profit or unrealized profit, there is an over provision of depreciation. So for an over provision, this is reducing balance method. What you can do is do a shortcut method of calculating by just taking the unrealized profit of 10,000. Take that unrealized profit, multiply with the depreciation rate 20%, this 20%, because that is the same PPE, property, plant and machinery, all use 20%, times 1 year. So this is only adjusted for 1 year, so 2,000. So quite easy. So debit motor vehicle, Intan is the buyer, retained profit, Payung is the seller. So when you do this, you have to adjust in your consolidation, do the consolidation adjustment in the consolidated statement, and also adjust in the schedule. Okay, next is the journal entry that you need to do for item bonus issue. My advice is whenever you come across bonus issue, it is best that you do the bonus issue before you start calculating the goodwill. But today what we're going to do is we're going to look at what reserve is being used for the bonus issue. Is it out of pre or is it out of post? If you look the statement here, general reserve is utilized for the bonus issue. So bonus issue declared being declared was a bonus issue of 1 for every 20. 1 for every 20, you will have to go and find out 1 for every 20 out of this 500,000. So if you do it here, 1 for every 20 times 500,000. So you will have 25,000. That is the amount that you need to issue as bonus share. To decide whether it will be taken out of pre or post acquisition reserve, you need to check whether you have enough pre-acquisition general reserve balance. So if you check here, the general reserve balance here is 50,000. This is the balance on the date of acquisition, the pre-acquisition reserve, right? So therefore, you will have to take from the pre-acquisition reserve, and there is more than enough to cover the bonus issue. So you will go and debit general reserve pre-acquisition balance. When you do that, it has to be adjusted in the fair value of net asset as well. So when you calculate goodwill, your fair value of net asset must be reduced with the bonus issue of 25,000. At the same time, when you go to your calculation in your schedule for the general reserve, that also needs to be reflected in the working. So here you need to have both, meaning that the fair value of net asset you need to adjust, and you also need to adjust in the schedule. So you need to also adjust in the schedule. So I put 2 colors there. At the same time, because you credit ordinary shares, since there are more shares being issued by the subsidiaries company, the shareholding has increased by the parent. That also needs to be adjusted in the fair value of net asset before you calculate the goodwill. So that need to be added to the share capital. How much? 25. Remember, you have enough balance. Next one is to do the item here, number 5. Item number 5 is regarding intercompany preference dividend. For intercompany preference dividend, you are informed that Intan Berhad has not credited preference dividend and interest receivable from Payung. So this is situation 3, because situation 1 is that both parent and subsidiary have recorded. Situation 2 is that both parent and subsidiary have not recorded the dividends or interest. Situation 3 is where subsidiary has recorded, but the parent, Intan for example, has not yet taken credit of its share of dividends and interest receivable. So situation 3, so if that is the case, what you need to do is you need to first notice that subsidiary has recorded, so it has been recorded. How much? If you go to the Sofp of Payung, you can see Sofp of Payung here. So what you would see is that, I'll take a different color. Okay. This does not work just now, right? So I'll take a pink color here. Right? Okay, never mind. So you have the preference dividend, and then you have your interest payable, and you have your ordinary dividend payable. So you have been informed earlier that this item, the preference dividend and interest receivable, were not recorded. That was just for dividend. And dividend here is not for ordinary dividend. Ordinary dividend is fine. It has been recorded if you notice. For ordinary dividend, it's not the same case. For preference and dividend interest payable, yes, they are situation 3. So when it's situation 3, what you need to do is the parent need to record their share of dividend, since they have not yet recorded the dividend and interest. So record for the parent to record the preference shares, dividend receivable. So go and debit the preference dividend payable here, the 6,000. Take the share of the parent. 30% is the percentage held by the parent in the subsidiaries preference share. So you will have 1,008. This will be adjusted later in your group statement of financial position, and that would be adjusted to remove the intercompany transaction. This will be adjusted in the schedule. In the schedule here, it should be adjusted in the schedule of the parent under the retained profit section. You need to add, right? However, for group consolidation, you need to remove that back. Okay, next is the debenture interest. You will repeat the same thing again. You will repeat the same thing. For the schedule, you are going to include the color there. It's going to be the purple. Sorry, it's peach color that I have chosen here. And the same thing should be done for the debenture interest. Only that the percentage for the debenture interest that need to be credited by the parent, since it has not yet been recorded, would be 50%. Why? Because if you notice, we have already done the working much earlier, that the percentage held by the parent in the debenture was 50%, whereas for the preference shares was 30%. So you need to bear in mind that percentage so that you will include the correct amount in the retained profit of the parent. Done with that, now we need to do the our number. We have done this, right? We have done this. Let us just do a little checking here. Done. All these are done. Okay, at the same time, we also need to check on the ordinary dividend. Remember, for the ordinary dividend, the 50,000 that you have here, you can see here 40,000 has already been included in the current asset section. This 40,000 is as a result of, I said earlier, we have to KIV, so it is 50,000 times the percentage acquired in the subsidiaries ordinary share was 80%. So you will have to check that and you would notice that gives you 40,000. Do not report this anymore. You need to go and cancel off. And this is situation 1 where subsidiary and holding have recorded the dividend. Subsidiary has debited, the parent also has credited its retained profit. And now what you need to do is to go and eliminate the intra-group ordinary dividend by debiting the ordinary dividend payable of Payung, reduce it by 40,000 and eliminate this income that was from the subsidiary company, income receivable from the current asset section. So if you do that in your statement of financial position, that has to be adjusted by removing from asset and liabilities respectively. Next is the last few things before we move on to our preparation of consolidated statement of financial position in the next video. So number 6, I've mentioned that the difference in the current account was due to the loan payment being made by Intan, by Payung. Payung took a loan from the parent company. Now Payung remitted 5,000, but Lintan has not yet received the payment as at the reporting period 31st of October 2000X2. For consolidation purpose, you need to go and assume as if the payment has been recognized or has been received. So this 5,000 will be reported as cash in transit. And how? You will go and eliminate that current account balances and record the cash in transit. So the current account balances, if you have here, for the current account here, it is 25. You will have to compare with the current account in the asset section. You can see that this comparison, right? You can see that is giving you a difference of 5,000, and that 5,000 has to be eliminated. So you will go and adjust that in the statement of financial position. Next one is the intercompany sale of inventory, where the intercompany sale of inventory was the seller is the parent, the buyer is the subsidiary, 25% invoice price, right? This is a margin. During the year ended 31st of October, the goods were sold and 60,000 and 50,000 of the inventories remain unsold. Out of the 60,000 that was sold, 50,000 were unsold. So the unsold inventory is given, which is 50,000. And Payung has yet to settle the amount due. So that 60,000 that were sold off between group members has to be eliminated here as the elimination of the amount owing, 60,000, because the sale was on credit. And the unrealized profit must be eliminated as well by removing it from the seller's retained profit. Our seller here is Intan. So you need to remove from retained profit of Intan the unrealized profit. How do you calculate the unrealized profit? Take the margin, 25%, straight away multiply by 50,000. 50,000 is the unsold goods. You get 12,500. Remove it from the retained profit of Intan, 12,500, and also remove from the current asset section in the group statement of financial position. So if you do that, that has to be done one in the schedule, another one would be in the statement of financial position. Before you go and find the group figure, you need to go and do consolidation adjustment to eliminate. At the same time, we have done this as well. These are all done for the elimination of the intercompany balance. Okay, I will continue with the remaining part in my next video to finish off the preparation of consolidated statement of financial position. With that, I'll see you when I will see you. Thank you for watching. Assalamualaikum and have a good day.